So we have the system fairly liquid. We've had the system opened with fairly liquid on Monday, and because of the week we had at the moment maturity, where the CBN tried to offer about 450. Sorry, the T-bill auction tried to offer 450 billion. However, it was undersubscribed by about 225 billion. So the system is still very liquid. We had, I think, most market participants were shying of going bullish for the auction because they felt they're expecting rates to go higher around the MPC meeting. The outcome of the MPC would lead to an increase or some adjustment to the rates, but since this didn't happen, market is still very liquid. CBN has the choice to conduct more almost sessions today or in the upcoming days to try and see how we could mop up that liquidity. However, today we also have retail auction. Banks will be funding for the retail auction, so that would largely mop up a lot of the liquidity. We expect about almost 300 billion will go out because of the retail auction today. So the excessive liquidity in the market will start drying up from today. And also, we expect CBN probably on Monday to float another OMO auction to try and mop up the excess liquidity we're having right now.
Okay, so you said the last OMO auction was undersubscribed, and it does suggest that many were hoping to get higher yields for their as they bidded for those bills. Do you get the sense that we're still going to see higher rates, or do you think the new normal is that rates will perhaps stay where they are right now?
Well, for the past almost 3 weeks, we've expected that we might see about 15% levels for the long-dated paper and for about 1 year bills. However, this hasn't happened yet. However, in the bond auction on Wednesday, we saw yields go up as high as 15.83 for the 10-year bond, and so we still feel there's a push towards increasing the yields, but I think the CBN has maintained a bit of resilience on that, and even if it does go up, it shouldn't exceed 15% before the end of the year.
I just want you to reflect on the MPC's decision yesterday. It was no surprise that they decided to maintain the status quo, but was there anything in the messaging and the communique by the central that the CBN governor delivered that really drew your interest and suggests what could happen in the future?
Well, I think we all probably feel that they wouldn't do anything to shock the system, especially as we're going toward an election year. However, we do know they mentioned the fact that, yes, although inflation had increased over the past 2 months, it moderated a bit last month, which is a positive sign. They also mentioned the fact that there's a bit of stability in the FX markets, and they can see rates, they're comfortable where rates are, and the reserve levels are, they're still comfortable with where the reserve levels are. We don't expect anything major to come in, at least for the end of the year, and maybe until after the elections. And hopefully, if oil prices still remain relatively where they are, above $60 level, we would be able to tie it over for the next maybe 6 months or something.
All right, so let's talk a bit about the outlook for the currency. In your view, given what the MPC has done yesterday, and we're not going to see another meeting till January, there's a prospect for a lot of liquidity coming into the system. I think that point was made yesterday as we analyzed the outlook for the markets. In December and January, potentially, there are quite a few maturities hitting the system. Do you think all that could point to some further weakness for the currency as the central bank tries to mop up liquidity?
I think CBN, so between now, and end of the year, there's about almost over 2 trillion in maturities, and also another 1 or 2 for the first 2 months of next year. So what I know, CBN would be actively involved in mopping up as much as it can to try and keep rates the way they are, and try to ensure that there's no shock to the system anyway that would lead to rates on the exchange rates going a bit further, depreciating a bit further.